On January 28, 2026, gold hit $5,589 an ounce, an all-time high. But that's not even the real story. The real story is who's buying it, and why the world's most conservative institutions are quietly walking away from what used to be the safest asset on earth. For decades, central banks trusted one thing above everything else: U.S. Treasuries. Boring, safe, guaranteed, not anymore. Gold now makes up a bigger share of central bank reserves than U.S. Treasuries, for the first time since 1996. Here are 3 reasons why that's happening and what it means for you. Reason number 1, the price doubled in 12 months. Gold didn't just go up, it nearly doubled. In January 2025, gold was trading around $2,700 an ounce. 1 year later, over $5,400. That's one of the fastest moves in gold's modern history. And it's not retail investors driving this, it's governments. In 2025 alone, central banks bought 863 tons of gold. Poland led the pack, adding over 100 tons to push its reserves past 550 tons. China has now bought gold for 16 straight months in a row. When the most risk-averse institutions on the planet move this aggressively, that's not speculation. That's a signal. Reason number 2, trust in the dollar is cracking. Here's the uncomfortable truth nobody at the bank will tell you. U.S. Treasuries used to be considered risk-free. That assumption is breaking down. Western economies are sitting on record debt to GDP ratios, and most are choosing to inflate their way out rather than pay it down. That erodes trust in fiat currency. And when trust in currency erodes, gold has done the same thing for 5,000 years. It becomes the place capital runs to. Even more telling, in 2026, 95% of central banks surveyed said they expect their gold reserves to keep growing over the next 12 months. That's the highest number ever recorded. This isn't a short-term hedge. This is a structural shift in how the world stores wealth. Reason number 3, the forecasts aren't slowing down. You'd think after doubling in a year, gold would be due for a correction. Maybe it will be, short term. But look at where major banks think this is heading. JP Morgan forecasts gold averaging $6,000 an ounce by the end of 2026. Societe Generale raised its own year-end target to $6,000 as well, calling it possibly conservative. Standard Chartered sees continued momentum from rate cuts, a weaker dollar, and emerging market demand. None of these are random predictions. They're built on the same pattern: central banks accumulating, the dollar weakening, and geopolitical uncertainty showing no signs of resolving. So does gold still have a future? The institutions that manage trillions of dollars in reserves are answering that question with their actions, not their words. You don't need to buy gold bars tomorrow, but understanding why the smartest money in the world is moving this way, that's exactly the kind of thinking that separates people who watch markets from people who understand them. If you want more breakdowns like this, subscribe. Next up, we're talking about something completely different: the psychology behind XRP investors.